Well, I think we're going to go ahead and start. So good morning and welcome to DocuTech's live TRIDcast, episode 15, I do believe it is. Today we will be talking about calculating cash to close and the other costs section of the loan estimate. But before we do, I want to introduce myself. I am David Thompson, your host today, and with me I have Fred Gooch, DocuTech's General Counsel and Vice President of Compliance, and Timothy Rady, one of DocuTech's Regulatory Compliance Specialists. Gentlemen, good morning. How are you today?
Doing all right.
Good.
Morning, David.
Good morning. Good morning. So I do believe we're going to start off with a question. Am I correct on that?
Yeah, we had a question come in on the previous TRIDcast and that we didn't have time to answer, so we thought we'd go ahead and answer that right now before we jumped in to our presentation on the loan estimate today.
Yeah, so the question we received is, if we do not list the lender-paid comp on the LE, do we still list the accompanying lender credit in box J? According to our research that we've done on this, TRID does not specifically address this issue. However, based from our gleaning of the official staff commentaries, our conclusion is no. The reason for that is the commentary to the LE specifically states that indirect compensation to the loan originator is not itemized on the LE, but it is itemized on the CD. That's in paragraph 37F1-2 of the official staff commentaries. And then the commentary to the CD for the similar section says all compensation paid to a loan originator, that is a third party associated with the transaction, regardless of the party that pays the compensation, must be disclosed on the CD. Compensation from the creditor to a third party loan originator is designated as paid by others on the CD. Compensation to a third party loan originator from both the consumer and the creditor in the transaction is prohibited. And that's in paragraph 38F1-2 of the official staff commentaries. So taken all together, it's clear from the commentaries that lender paid LO compensation, whether it's to a third party LO or to an in-house LO, is itemized on the CD under the paid by others column. As a result, you would not put a corresponding credit for such compensation on the LE. Otherwise, you're going to have to carry that credit from the LE onto the CD, as well as add on top of that the itemized compensation. So in effect, you're disclosing two types of LO compensation on the CD, and thus your totals will be inaccurate as a result.
Okay. Excuse me. Thanks, Timothy. And that should wrap up all the questions that we had from last week. So we're going to go ahead this week, and we're going to be talking about the other costs section on the loan estimate, as well as the calculating cash to close table. So if you look here on the screen, you can see we're utilizing one of the CFPB's model forms for convenience today. You can see that there are four different sections, really four different subsections of itemized costs that will appear here in the other costs section. You've got the taxes and other government fees. You've got the prepaids, the initial escrow account paid at closing, and then the other section. Now, taken together, the fees that are going to be disclosed in this other cost section are fees that are a result of government action, or fees that are a result of standard calculations that are going to be applied to ongoing fixed costs associated with the loan. And then all of these obligations that are going to be disclosed are they're independent of the creditor. And you would also, in this section, you would also include items that would be required as part of the sales contract. They could be disclosed on the LE in this section to the extent that they would be known by the creditor at the time that they issued the loan estimate. Now, the items that are disclosed here, they have to be disclosed in the particular order that they were set forth in the regulation. So you can't take anything that's on the form, the hard-coded sections, and you can't move them. Also, each of these sections have different numbers of items that can be included in them, and you can't exceed the number for each specific section. The regulation is clear here that you also cannot use an addendum here. So if you go over the amount of fees that are permitted in any given section, then you would use the method where your final line would be additional charges, and then you would sum up the additional charges. And so that is kind of an introduction to the section. Now, the first section that we're going to take a look at is the taxes and the government fees. So the first thing that you're going to disclose here are the recording fees and the other taxes, and then you're going to disclose the transfer taxes second. These are hard-coded items on the form, and they have to be disclosed. So your recording fees and other taxes are fees that are assessed by a government entity to record the lien. So you're looking at recording the mortgage or any of the documents that are required by law, or any other fees or charges that are imposed by the government that are not transfer taxes. Now, transfer taxes are the state and local fees that are on that are based on the loan amount or are based on the sales amount of the property. Now, they can have different names based on the locality. However, if you're looking at the type of taxes here, so irrespective of what you may call it in your locality, then you would just apply the definition, and if it's a transfer tax, it goes in there. So also to note here, only transfer taxes that are paid by the consumer are going to be disclosed on the loan estimate. Also, if there is you're going to look at whether there is a conditional lien that would be based on the payment of charges. And if the fees are not directly attributable to the consumer, then you would disclose the amount that is the common practice in the locality of where the property is located. So this would be if you've got a split between consumer and seller paid taxes. If you were going to be apportioning any of these transfer taxes or the recording fees, you would apportion them between the buyer and seller based on the common practice in the industry or in the jurisdiction where the property is located. And just a final note here on the taxes and other government fees section, you can't list any other additional items, and you cannot delete the items. So you see on this example, there are no transfer taxes. So it's just left blank on the form, which is a little bit counterintuitive, but we've seen that from time to time in these documents where you just leave blanks as opposed to putting an NA or a 0. Whereas with a lot of particularly with a lot of state laws, you're going to see them saying you can't have any blank spaces, so you got to put NA or 0. So it's just a little bit of a difference in the approach between a lot of the states and what the CFPB is asking us to do on these TRID forms. So the next section that we're going to take a look at is section F, the prepaids.
All right, so one thing to keep in mind with this prepaid section, and this was a item that several in the industry commented about during the comment period of the proposed rule, is that prepaids are the amounts that are being paid upfront at closing for a certain period of time for various items. The 4 items listed here on our example are hard-coded: homeowners insurance premium, mortgage insurance premium, prepaid interest, and property taxes. These are not the amounts that are going to be put into an escrow account, which will be used to pay off these items at a future period of time. These are amounts that you're going to be paying upfront at closing and will not be put into an escrow account. So the first one, homeowners insurance payments, you are going to disclose the amount of months that the consumer is going to be prepaying for homeowners insurance premium and the total for that amount. Now, one thing to keep in mind is that TRID defines homeowners insurance through a series of cross-references that all lead back to Section 4B8, which is our finance charge section under Regulation Z. And the definition for that is for homeowners insurance is loss of or damage to property or against liability arising out of the ownership or use of property. And that definition will include other items that we normally roll into homeowners insurance premiums, like flood insurance. But the commentary is quite clear that you are going to roll such items as that into the homeowners insurance premium row. Your next one is going to be mortgage insurance premiums. Again, you're going to disclose the amount of months collected, being prepaid, and the total amount there. And again, they refer back to Section 4 of Regulation Z, where mortgage insurance includes insurances protecting against the consumer's default or other credit loss. So any type of insurance premiums that fall under that definition are rolled up into that line. The third one, which is prepaid interest, discloses the amount of prepaid interest to be paid per day, the number of days of which the interest is being collected, and at the interest rate, which is also disclosed on page 1 of the LE. One thing to note here, you'll notice that in the example here, the totals are all rounded numbers. However, the dollar amounts that you are disclosing for prepaid, as well as the interest rate, are not per se rounded. You disclose the actual dollar amounts for the interest being collected, and for the interest rate, you either need to round that up to you round it up to 3 decimal places, or you truncate it at 2 decimal places at your discretion. Finally, the last hard-coded line is property taxes. Again, you disclose the amount of months being prepaid and the total. And the property taxes include the items used to determine the property taxes in the taxes, insurance, and assessments, or what we like to call the TIA section on page 1 of the LE. Again, if no amounts are being collected for these items, you cannot delete the hard-coded lines. You have to leave them blank. You can disclose up to 3 additional prepaid items in the section, and again, as Fred had mentioned, if you have more than 3, you have to take your third line and list additional charges and disclose the total there. Some of the additional items that the commentary gives as examples are real estate property taxes due within 16 days after consummation, past due real estate property taxes, mortgage insurance premiums, and so forth and so on. And that covers it for prepaid, so the next section is going to be initial escrow payment at closing.
So section G is the initial escrow payment at closing, and this is where you're going to disclose items that the consumer is going to place into an escrow or reserve account at the consummation of the loan that are going to be applied to recurring periodic payments. So you see here that you've got your homeowner's insurance, mortgage insurance, property taxes, and you can have a maximum of 5 other items in this area. You must disclose the amount escrowed per month for each item, the amount of months collected at consummation, and the total paid. So if you look at this example, you can see the homeowner's insurance. They are going to be escrowing $100.83 per month for 2 months, and that's what's going to be collected up front for the $202. There is no mortgage insurance on this loan, so the line is blank, as we've discussed as well. It's pretty straightforward in this section. Once again, the similar rounding rules apply in that you're going to be utilizing the rounded numbers in the subtotals, but inside you're not going to be utilizing the rounded numbers for the escrow payments. So now we'll move on to the next section, which is the other charges. And one of the things I wanted to do here before we switch over to another example that actually has another charge listed.
Appreciate that. Thank you. So under the other section, you're going to list up to 5 other amounts that are being charged in connection with the loan transaction that the consumer is likely to pay or has contracted with a person other than the creditor or loan originator to pay at closing, and which the creditor is, of course, aware at the time that he issues the LE. Each of these items are to contain descriptive label. They're alphabetized like other sections in this form, and the subtotals of all amounts should be disclosed. We have a couple of interesting rules with section H. This is where you would normally disclose your owner's title insurance premiums. Any item that has a component of title insurance, similar to sections B and C, have to contain the prefix title before the actual description. Now, the interesting thing with owner's title insurance, you also have to put in a suffix in parentheses of optional. Now, one thing you have to keep in mind with section H is all the fees being disclosed in H are optional fees. All the ones that are required are going to be listed in B, C, or A of the LE. So all items in H are going to be optional, but the only ones that are actually going to contain the caption optional are the owner's title insurance, and that was done for the purpose of informing the consumer that they do not have to buy owner's title insurance. That's an optional item on their part. If you do disclose owner's title insurance premiums, you only disclose the amount based on the basic owner's policy rate and not on any enhanced title insurance policy premium, unless the premium for the enhanced policy is for an enhanced title insurance policy required by the real estate sales contract. In addition, if a special rate is available based on a simultaneous issuance of a lender's and an owner's policy, the premium may be calculated and disclosed in the following two ways. One, the title insurance premium for a lender's title policy is based on the full premium rate. And second, the owner's title insurance premium is calculated by taking the full owner's title insurance premium, adding the simultaneous insurance premium for the lender's coverage, and then deducting the full premium from lender's coverage. And that basically rounds out what Section H is for. Some other items that might be disclosed in here besides owner's title insurance can include real estate broker compensation, additional payments to the seller to purchase personal property, HOA and condominium charges associated with the transfer of ownership, and fees for inspections that are not required by the creditor.
Okay, so the next section is pretty easy. We're going to take a look at section I and J here. I and J is where we total all of the other costs that were disclosed in E, F, G, and H. So it's simply the totals of all the subtotals in the other categories. And then in section J, you're going to take the totals of D and I. So that is your loan costs and your other costs, and you're going to total them. And then the other disclosure that you have here in section J is the lender credits. Now, lender credits are the amount of payments from the creditor to the consumer that do not pay for a particular fee on the LE, and this will be disclosed as a negative number. So there's a lot of questions out there about the way the lender credits are to be applied and whether you put all of the lender credits on there or whether you would apportion them to a specific fee. The way that the commentary reads here is it does seem to indicate that you would only put the fees that are not apportioned towards a particular service, but we have seen a lot of different approaches and different interpretations out there in the industry, and so we've coded our software once again to accept either method here. So after the total closing costs, the next section is the calculating cash to close section.
Section is specifically geared towards any math junkies who might be listening in on our TRIDcast today. I will try to give as brief a description as much for each row, so please bear with me. So calculating cash to close, this is basically the purpose of this table is to inform the borrower of how much cash he's expected to bring at closing, or how much might be owed to him depending on what kind of loan and how the math turns out. So going with the first row, J, total closing costs, you're going to display this as a positive number in all cases, and that is going to be your total from section J, which Fred had just talked about. Your next row, and again, this is with our standard table. There is also an alternative table that we will be discussing here shortly, but this will be your standard table that you'll see in most transactions and certainly in all purchase transactions. So closing costs financed, paid from your loan amount. This one has received quite a bit of flack in the industry. A lot of questions have come in about how to calculate this total. The official staff commentaries actually provide a formula for calculating it, and it is basically as follows. The amount is calculated by subtracting the estimated total amount of payments to third parties which are not otherwise disclosed under either the loan cost or other cost tables. If the result of the calculation is a positive number, it should be disclosed as a negative number under closing costs financed, but only to the extent that it does not exceed the total amount of section J. If the result of the calculation is zero or negative, an amount of $0 should be disclosed. So in this section, unlike previously where you would simply just add together the amounts being financed, you're actually having to take third-party charges which are not otherwise disclosed in the loan or other cost table and subtracting that from other amounts. The calculations we've done on don't actually come out with an accurate picture. Expect this might be something that the CFPB may adjust in the future, but for right now, this is what the official staff commentary comes out with the calculations, and if you follow the official staff commentary, according to Regulation Z, if you do so in good faith, you're free from any liability on your part. So under the next row, we have label down payment funds from borrowers, and you disclose the following amounts as appropriate. So for a purchase loan, which would be your down payment, you're going to disclose the amount of the difference between the purchase price of the property and the principal amount of the loan, and you'll disclose this as a positive number. For all other non-purchase loans, which will basically cover the funds from borrower, you're going to use a calculation which is going to be very similar to funds for borrower, which is a couple of rows down. This number is determined by subtracting the principal amount of the loan, excluding closing cost finance from that principal amount. And you're going to take that number and you're going to subtract that from the total amount of all existing debt being satisfied in the transaction, except to the extent the satisfaction is such as disclosed under other costs, which is also further down the table. However, for funds from borrower, if the calculation results in a positive number, then the number should be disclosed. If the calculation results in a negative number, then $0 should be disclosed. And of course, if the calculation results in $0, then $0 should be disclosed. If the loan amount exceeds the purchase price of the property, other than for a construction loan, amount of $0 is disclosed. Going to our next row, which is deposit. For a purchase loan, you disclose the amount of the earnest money deposit, and you disclose it as a negative number or $0 if there aren't any. For all other loans, you'll disclose the amount of $0. Now going to our funds for borrower section, the amount is calculated the same as for funds from borrower, which again is subtracting the principal amount of the loan, excluding closing costs financed, from the total amount of all existing debt being satisfied in the transaction, except to the extent the satisfaction of such debt is disclosed under other costs. However, unlike the funds from borrower row, if the calculation results in a positive number, $0 is disclosed. If the calculation results in a negative number, then such number should be disclosed. If the calculation results in 0, then $0 should be disclosed, and if it is a purchase loan, you would still disclose $0. Under seller credits, again, we come to that issue that has been plaguing the industry for a bit, whether you use specific seller credits and deduct those from the amounts disclosed in the loan costs or other cost section, or whether you lump these all together in the seller credits row. But just to give you what we've gotten from the commentary, it is you disclose the total amounts the seller will pay for Section D and Section I costs. You'll disclose this as a negative number. However, to the extent known to the creditor, seller credits for specific items under loan costs and other costs are represented by the total amount disclosed for such items. Going to the next row, adjustments and other credits, you disclose a sum of all the following items, and you disclose this as a negative number. A disclosure of all loan costs and other costs that are paid by persons other than the loan originator, creditor, consumer, or seller, such as gifts from family members. Credits from such other persons, such as a developer or home builder organization providing credit. Proceeds from subordinate financing, local state housing assistance grants, or other similar sources. Any other amounts that are required to be paid by the consumer at closing pursuant to a purchase contract, and the amount of any additional items that the seller has paid prior to the real estate closing but reimbursed by the consumer. And you would include amounts disclosed as sale price of any personal property included in sale or Section K due from borrower at closing on page 4 of the CD, as well as the amount of any other items owed by the consumer, which are disclosed as adjustments or Section K on page 4 of the CD. Then finally, you would disclose the sum of all these previous amounts, and that will be your estimated cash to close on the standard table.
Thanks, Timothy. That's a whole mouthful right there.
That is a whole mouthful.
That is a lot of information.
Yeah. I'm going to briefly go over the alternative cash to close. table. Here we go. So this is the alternative cash to close table that you could use for a transaction without a seller. Now, if you're going to use this table, you need to make sure that you use the alternative costs at closing table on page 1 of the LE. So if you come up here in this example, you'll see the alternative table disclosed up here on page 1 as well. So for the alternative table that's going to be used in transactions without a seller, and this is an optional table, you're going to disclose the loan amount, which is the same as the loan amount that you put on page 1 of the LE. You're going to disclose the total closing costs, which is the amount in J, and then you're going to disclose the estimated payoffs and payments. So this is the total amount that's going to be paid to third parties that's not otherwise disclosed in the loan costs or the other costs disclosed as a negative number. Examples of these costs would be payoffs such as liens or mortgages, mechanics liens, tax liens, unsecured debts of the consumer, or payoffs to third party that are required as part of the extension of credit. So then you're going to also disclose your estimated cash to close, and this is the sum of these items, and it indicates whether the cash will be required by the consumer or will be paid by the consumer. So whether cash goes to or from the borrower. The last disclosure here is the estimated closing costs finance. And this is the sum of the loan amount and the payoffs and payments, but only to the extent that it is greater than 0 and less than or equal to the sum of the total closing costs. So that's how the regulation tells you to disclose that amount. We've got a few minutes left. We're going to answer a couple of quick questions. Okay. So the first question is, where and how would we disclose lender-paid mortgage tax for New York loans? We talked about this briefly in the taxes and other government fees section. Only transfer taxes that are going to be paid by the consumer are to be disclosed in the loan estimate, as I recall. That's what the rule tells us. The next question is, if an appraisal is received and the value is presented subject to, say, a new roof, are we required to quote the costs on the LE of the cost to replace the roof and a service provider who would perform the roof replacement in the 10% variance category? That's not one that I have come up across.
I haven't
Have
either.
you seen that, Timothy?
I think thinking through it logically, you have to come down to whether this is going to be a service that you're going to require the borrower to do in order to close the loan. I think if it is a required service, of course it would be disclosed in either Section B or C, depending on whether you allow the borrower to shop for the service person to fix the roof. If it's optional, if it's something that you just want to inform the borrower about, hey, go in Section H. Now, as far as the tolerance category, again, that's going to come down to whether you require that as a service or not. If it's not a required service, it'd probably be subject to a good faith tolerance category. If you are going to require it, it is going to fall into your 10% bucket. I think this could be something you could have a valid change of circumstance for, however, so you could provide a revised LE with the new loan amount, because this is information that was not known to you at the time you provided the original LE. There was a change that was outside your control, outside of the borrower's control. So I think this is something that you could provide a revised LE and reset your tolerances over.
Yeah. Nope, that sounds good. That's all the time that we have this week, so we're going to go ahead and finish up. David.
All right, well, thank you both. Definitely appreciate all the information, guys. I know that was a lot. For all of our viewers out there, DocuTech would love to answer any of your questions as it pertains to TRID. We are getting closer, so if you have any questions, feel free to submit those at trid@docutechcorp.com, and our next episode will be on September 22nd, again at 10 a.m. Mountain Standard Time, where we will be going through the adjustable payment table and the adjustable interest rate table. To learn more about DocuTech, see a previous episode, or to see this episode if you would like to watch it again or show it to your team, visit www.docutechcorp.com. You can also reach a member of our team at 800-497-3584. And again, thanks for watching, and thank you to everyone who joined the live webinar today. We appreciate it, and we will see you next time. Thanks.